Hello everyone, I'm TQ. Today we're breaking down last week's market moves and what they mean for both macro and crypto. Three things drove pricing swings: a soft PCE print, which nudged risk appetite higher, headlines about political interference with the Fed, which raised policy uncertainty, and finally, NVIDIA's data center revenue came in slightly below expectations, sparking a pullback in the AI and tech complex. Overlaying all of this, the dollar and real yields continued to tug on broader markets. So let's walk through these drivers. First, July PCE rose 2.6% year over year. That kept the soft landing narrative in play and supported risk appetite. Second, reports surfaced that Trump sought to dismiss Fed officials. That stirred concerns about Fed independence and flipped the market lens toward policy uncertainty. The dollar dipped, gold caught a safety bid, and curve volatility picked up. Heading into the weekend, NVIDIA's results showed data center revenue just shy of consensus. That triggered a broad pullback across AI and tech, with the Nasdaq and high beta names leading declines. BTC and ETH softened alongside sentiment, giving back some of their earlier relative strength. So, three catalysts took turns pulling markets between two zones: a hot zone of rising real rates, a firmer dollar, and pressured risk; a cooler zone of falling real rates, a softer dollar, and recovering risk appetite. The result? Amplified weekly volatility. For this week, two yardsticks matter. First, jobs and wages. Will they push the narrative back into the hot zone? Second, the FOMC's messaging and the pace of QT. Can they extend the current benign window? Whichever side delivers a stronger signal is likely to set the tone for September. Turning to the industry side, U.S. crypto policy activity has picked up. Progress is being made on a federal stablecoin framework. There's debate over whether ETFs should be allowed to stake, and the definition of trading venue is under review, with stricter interpretations back on the table. Against that backdrop, the big question is, after 3 quiet years, can DeFi mount a structural comeback in the second half of 2025? The DeFi Education Fund, originally funded by the Uniswap community in 2021 with 1 million UNI, has been active on policy. Its mission: explain DeFi to lawmakers and regulators and advocate for fact-based, tech-neutral rules. Recently, the group encouraged more projects to apply for SEC no-action letters. So what is an NAL? It's a written assurance from SEC staff that given a specific fact pattern and representations, they would not recommend enforcement. It is not an exemption, not a rule, and applies only to the facts presented. But it can reduce enforcement uncertainty and provide banks, auditors, and exchanges a clearer basis to engage. In crypto, that means demonstrating non-custodial design, neutralizing front ends and SDKs, disclosing risks without promises of profit, and building auditability into upgrades, monitoring, and kill switches. Why push NLs now? On the macro side, inflation is trending gently lower. The Fed is expected to ease slowly, and spot ETFs plus RWAs are bridging crypto and traditional finance. Clear compliance postures now earn cheaper capital and higher limits. On the regulatory side, definitions of exchange are still debated, but there is room for neutral software. NALs provide a faster, more practical compliance path than waiting for full rulemaking. And on the project side, after years of enforcement and tight funding, what matters isn't new narratives, but compliant templates that unlock custody, bank accounts, and listings. In short, NALs could become a repeatable compliance model for DeFi, and whoever gets there first will likely enjoy a capital and liquidity premium. Now let's move from policy to flow. Despite hot and cold macro data, ETF subscriptions showed renewed demand. Bitcoin ETFs flipped from week 34's 1.178 buy dollar outflows to 440 inflows in week 35, a 1.6 buy dollar improvement. Ether ETFs improved from $712 to plus 1.8 cents, about a $1.8 swing. The takeaway: ETFs are still net absorbing supply. Pullbacks look macro-driven, not structural. At the margin, allocation still tilts toward Ether. The challenge is cutting through headline noise. Every day brings reports of ETF creations and redemptions, or strategic reserve wallets buying and selling. In rallies, we only notice inflows. In sell-offs, only redemptions. Perception swings faster than fundamentals. That's why we need steadier baselines. Here I propose 3 metrics: share of float, how much of circulating supply is held by ETFs and reserves; concentration, whether those holdings are spread out or clustered; absorption ratio, net buying relative to new on-chain supply; Looking at ETH over the past 30 days, ETFs hold 6.79 men in ETH, or 5.6% of float. Strategic Reserve (CR) hold 4.44 men in ETH, or 3.7%. Together, that's 0.9% of supply in institutional hands. Concentration is high. On the ETF side, ETH alone accounts for 3.14% of total supply, and ETH-E another 0.99%. CR3 85.6%, CR5 98.4%. In practice, inflows and outflows are dictated by fewer than 3 products. On the SER side, holdings are also top-heavy but have a longer tail, with 70 treasury companies participating. Top 3 CR treasuries alone account for 2.43% of supply. Absorption ratios are well above 1. On a 30-day basis, ETFs equals 11.19 TES, SER 11.49s, combined 21.68 TETs. On a 7-day basis, combined equals 24.42 TEX. That means incremental demand is being met by secondary turnover, not new issuance, supportive for price. The past week highlighted how quickly markets can swing between hot and cool zones depending on data and headlines. For now, the balance rests on jobs, wages, FOMC messaging, and the pace of QT. For crypto, U.S. rulemaking and ETF flows are the 2 watch points. On policy, DeFi's compliance path may come through SEC no-action letters. On flows, ETF and reserve absorption remains strong, with concentration risk the main caveat. In other words, markets remain volatile, but the underlying demand shift toward Ether looks intact. That's it for today's breakdown. I'm TQ. See you next time.